As a financial planner, the question I probably get asked most is how much do I need to have saved to actually retire? Hi, I'm Jordan Curnutt, a certified financial planner here at Quantum Financial Planning. Now, the answer to this question varies widely. My firm has worked with clients that have saved $1 million and have retired happily and comfortably. My firm has also worked with clients that have saved over $5 million into their retirement accounts, and when we've built that first financial plan, it didn't come anywhere close to working. So while how much you have saved is certainly a meaningful component of the retirement equation, it's only part of the formula. The most meaningful part tends to get overlooked, and that's how much are you actually spending? What does your lifestyle look like? Do you still have debt? Are you supporting a parent financially in retirement or maybe a child? What's your tax situation? The answer to each one of these questions has a direct impact on your required retirement number that you're going to need in order to make it in retirement. And the hardest part is many times the answer to the how much are you spending question is a complete unknown. So if you're getting ready to retire, start dialing this number in. It's information you're going to need to know and communicate with your financial planner for them to build an accurate financial plan. Now, I know that this can sometimes feel a bit overwhelming, especially when you're starting from ground zero, but I have good news. There's literally only 4 places that your money can possibly go. 4. That's it. So once you get these 4 areas dialed in, you can feel confident that you have a good grasp on what the retirement income needs you're actually going to have in retirement look like. So here we go. Here's the only 4 places that your money can possibly go. All right, we're going to head over to our financial planning software. I've got fictional clients, Mike and Stephanie McDonald, pulled up. This is their net worth sheet, or the blueprint we like to call it. But today we're going to go ahead and dive into the retirement section and go ahead and look into the cash flows, because that's where we're going to find these 4 different retirement spending areas. So I'm going to move over to the summary, and here we go. All right, we got a lot going on this page, but I promise it's not so confusing. So it starts off with our cash inflows. We're going to ignore that for the most part today. Super important, but it's not what the topic of today's video is. Today, we're going to focus on cash outflows. So as I mentioned, as we started off the video, honestly, there's only 4 places your money can go. It's really kind of crazy, but it's the truth. So I'm going to go ahead and work backwards, and I'll tell you why here in a second. But let's go ahead and start off with thing number 4 on our list of the 4 different areas your money can possibly go, and that's planned savings. So as you can see here, we're going year by year. So this is 2026, 27, 28, all the way out to, we're running them to ages 93, the year 2064 in this plan. But while they're still working, we can see that we have planned savings. Now, Mike and Stephanie are planning for an early retirement. You can see over here in the inflows that there's no more income coming in after part of the way through age 57. And so we can see in order to make that work, they're saving aggressively. They are getting after it. Super cool to see, but they're saving $96,000 a year in this scenario. Now, this could be anything from 401k plans, Roth IRAs. In this scenario, they'd likely be looking at the backdoor Roth IRA method in order to do that, just because of where their income is. This could be a SEP IRA if they're a small business owner. Honestly, anything where you're putting money away is going to go into this planned savings column. And really, that's it. Pretty easy. So when we go ahead and look on an annual basis, if you're doing this at home, how much did you save in the year 2025, in the year 2026? What are you on track to save? That's the number that's going to go here. All right, let's go ahead and move over to the second place that our money could go, and that's to taxes. So this is where we have a ton of variability, pretty crazy. So in 2026, we can see that we're estimating $77,000 going to taxes. Fast forward to 2029. Goose egg. So we have a 3-year gap here. Again, to me as a financial planner, this screams tax planning strategy. So again, not the topic of this video, but if I'm working with this individual, that's definitely something we're going to go ahead and take advantage of. This is something that varies dramatically, much different in your working years and then as you transition to retirement. But let's go ahead and click in and see what this can be made up of. So in this financial plan, we only have 2 different places. For a lot of folks, there's three. So I'll address these two first. The first is federal. This is going to be ordinary income. So if you're working, the tax that's being withheld and your employer's paying to the IRS on your behalf, those dollars are included here. The other thing that can be inside of this federal column is capital gains taxes. So if you're saving in a taxable brokerage account, the taxes that are generated and due from those types of accounts are also inside of this federal number. The next column that we have here is FICA. That's just going to be your Social Security and Medicare tax. So one of the things you'll notice here is that's only applicable while you're working. So literally I scroll down forever as they're entering retirement. Say goodbye to FICA. So eventually you'll actually be getting the benefits. You'll be on the back end of that math equation, but you do want to make sure we're accounting for paying into it and during your working years. And then the third column, the third category, is it here a lot of times, but not for Mike and Stephanie in this scenario, is state income taxes. So the reason it's not on here for them is they're residents of the state of Washington. We don't have a state income tax here in Washington, and so they don't have to worry about it. It doesn't show up in the software. If you're a resident of California, for example, that's going to be a meaningful part of your cash flow. You're going to want to make sure that we're planning for your state income taxes as well. All right, so we can save it. It can go to the government in the form of taxes. The third place that your money could possibly go is goals. And so you can see this number varies dramatically once again throughout the course of a retirement plan. Let's go ahead and click in and see what's going on here. Okay, we have 4 just like super common goals in here. This is just a small peek at what could possibly go here. But really what we want to show in the goals category is anything that's not going to be handled out of just like your regular monthly cash flow. So these are usually like bigger ticket items, one-time things. So like a vacation goal, for example, in this case, $15,000 a year. We want to make sure that they're affording that one in their working years. That's something they want to continue. It's a passion of theirs to travel. They want to continue to do that in retirement. We want to reflect that and make sure that their lifestyle can stay the same both while they're working and in retirement. So that's what's going on here in that third column. Gifting. So in this scenario, this is charitable giving, $12,000 a year. Typically in my head, that screams $1,000 a month. And so one of the things that modern financial planning software is super good at is tax planning. So it's going to go ahead and give them a benefit on their tax return if applicable. Charitable giving goes down as an itemized deduction. So if they do breach that standard deduction amount, they'll go ahead and get tax credit for that on their tax return that we're planning on. So charitable giving, vacations, cars is another big one. So a lot of times, in this scenario, a somewhat early retirement, age 57 is what we're looking at. You're probably going to need to purchase a vehicle or two more over the course of your life. In this scenario, we're modeling every 5 years between the two of them. So $50,000 is what they've identified as roughly how much they're going to spend on a vehicle. And then you'll notice it's a random dollar amount here in 2028. Well, that's because we're accounting for inflation. So this is a $50,000 car today, but we need to make sure that we all know that a $50,000 car today is a different amount in 3 years, in 8 years. And so the software has built into it the ability to model inflation. And you can see as we go out every 5 years, by the year 2053, that same $50,000 vehicle will now cost $97,000. Again, same vehicle. This isn't all of a sudden turning into this crazy luxury vehicle. It's still a $50,000 car, just in future dollars. And then lastly, we have education. And this fictional plan, I think we have them with one child. Just one child here. And what we're looking at is 4 years of college. And so again, the software is super good at getting really granular if we want to. We pick a specific university. In this case, we just have it turned on as the average cost for 4 years at a public in-state tuition university. But again, something we want to make sure we're planning on. That's not an every year thing, but that's a chunk over the course of 4 years. So we want to make sure that it's built into the plan. So under goals, again, there's a bunch of other things that we can model here. This is 4 really common things that we do for clients all the time under the goals category. All right, so we've made it to the fourth thing, the last area that your money could possibly go, and that's expenses. What a generic category. But let's go ahead and click in and see what it actually looks like. So here's the 4 places that your money could go inside of the expense category. I'm gonna go from right to left, kind of backwards here, and I'll tell you that why here in a second. But healthcare. So in this scenario, you can see we have a goose egg for the first 2 years. Reason for that is they're working in this scenario. Employer pays for health insurance, no out-of-pocket costs there. And then we want to make sure that once they retire, likely going to be going on to the exchange because they're not 65 yet, in which case we could get them on Medicare. So we want to make sure that we're reflecting that cost in retirement. So that's what we have here modeled in the healthcare section. Debt, let's go ahead and click in. Okay, right now Mike's got a car loan. So that's something that we know won't last forever. We're modeling out those payments, partial payment in 2031, and then it drops off. So the next one is housing. If you rent, we can model your rent here. More often than not, the folks we work with own their home. If we click in, it's going to look different whether or not they have a mortgage or not. So in this instance, they do. So we have the principal and interest from the mortgage being reflected each and every year. We also want to make sure that we count for the property tax and insurance, or if you have an HOA associated with your home, we're accounting for that. And the reason that this is important that we break this all out is if we scroll down, eventually we know that mortgage is going to get paid off, but I'm sorry to say your property taxes and insurance aren't going anywhere. So we drop off that part of your mortgage payment, but we make sure that, as you know, if you've ever paid off a mortgage, typically go to paying your property taxes twice a year. And then the insurance a lot of times just wraps into your monthly P&C payment. So anyways, we want to make sure that we have your housing properly accounted for. And lastly, we have living expenses. So again, in this scenario, the reason I saved living expenses for last is this is, in a lot of cases, the toughest one to nail down. So in this case, we're modeling $72,000 a year, which is $6,000 per month. And this is going to encompass everything else. So anything that we have not talked about will get thrown into this category. This is things like eating out. This is things like if someone comes and mows your lawn once a week, that goes into this category. Anything that you do on a daily basis that we have not already talked about, other insurances, for example, would be thrown into this category. That lands here. And this is the one that people really struggle with. A lot of times what I'm talking through with folks as they're trying to get this number dialed in is use the tools available to you. There's a bunch of different softwares out there that will track your spending. You can link your credit cards, link your bank account, and it'll aggregate all of those transactions, leave it running for several months, and then go back and look. It does the math for you. I'm less concerned with each category from a financial planning perspective, just because I do just need that overall number. For you, sometimes it's super insightful to know, hey, I'm spending X amount of dollars on eating out per month. Is that important to me? Is it not? Those types of things. So again, from a financial planning perspective, we need that total number. I do think there's a lot of meaningful insight in just knowing where your money's going. So use the tools available. If you're working with us, we do have our own tool in-house that we allow folks to use to really dial that number in. If not, there's tons of different free softwares available online that you can use as well. So here's why this is important. So again, we're not really talking about inflows today, but I need to talk about it real quickly to just wrap up why this is meaningful and why we go over this. So in this scenario, we have $325,000 coming in as earned income. Then you can see we sum up the 4 places your money could possibly go, $323,000. And then this is what's left over in this spend unsaved cash flows column. So in a perfect world, this column is 0. What that means is we've told every dollar exactly where it's going. Never going to happen. I've never had it happen. $1,815 off, pretty darn close. I would be very satisfied with a financial plan and could feel very confident in the numbers that we're putting in if I said we were this close to 0. A huge number here would signify to me we need to do some digging because we have a disconnect between the inflows and the outflows in this plan. So anyways, the closer to 0, the more confident that we can feel when we're building out your financial plan. All right, so let's pull this all together. There's only 4 places that your money can go in retirement. They can go to living expenses. They can go to goals, taxes, or savings. That's it. Once you get clarity around these 4 areas, what your lifestyle actually costs, what you want to do, what you'll owe in taxes, and how your savings change, especially as you transition to retirement, you start to turn what can be a really overwhelming question into something that is much more simple and manageable. Because the goal isn't just to hit some random retirement number, it's to build a plan that actually supports the life that you want to live. But here's the reality. Most people don't struggle with understanding these categories. They struggle with putting all the pieces together into a clear and confident financial plan. So if that's where you are right now, we'd love to help. There's a link down in the description where you can schedule a conversation with a certified financial planner on our team. No pressure, it's just a chance to get clarity and make sure that everything is working the way that it should. If you found this helpful, be sure to like and subscribe so you don't miss what's coming at you next. Thanks for watching, and we'll see you on the next video.